Hello, everyone. Thanks again for making your way into the room. I know we had a tight timeline for lunch, so I really appreciate you coming on in. So at this time, I am so happy to be able to welcome Dean J. Hartzell and John Goff for our keynote interview today. I'm going to let Dean Hartzell share a little bit of his background and also do an introduction for John. And at the end of their interview, we will have some time for questions, and we do have microphones in the front for questions. So please welcome Dean Hartzell and John Goff.
Thanks, Christine, and I would say thanks for that great introduction, but it was pretty much introduce yourself, Jay. So first let me say welcome, and we had a big team that worked a lot on this event, and we're excited about the way this is going. Give us feedback if you hear things or think of things that we could do differently. The idea in a nutshell, which you probably heard from Emily this morning, but was to bring together some disparate, different reunion-type events that we did program by program with a hint of what we've done as the Alumni Business Conference and try to really deliver, we hope, substantive content and also provide a reason for everybody to come back and re-engage with campus. So it's a pleasure to see a lot of friends and familiar faces. Special shout out to the MBAs from '04. That was my second class that I taught here. We've been running a controlled experiment trying to see if the students who had my sections did better or worse. We're not going to tell you the results of that, but I'm glad that you've forgiven me and are willing to come back. So I appreciate seeing you all again. So I want to say thanks to John for doing this, and we went down the list and tried to figure out who we could bring in that would be a fitting keynote for our first homecoming branded weekend, and John was the first call I made, so thank you for doing this. And so the idea we thought was a little bit of John's story and also some ways to think about what's going on in the world today, but then with an idea for cute questions and answers. And we've got mics down here when that part comes up, but also I think you're okay with the interrupt us and
yeah, absolutely.
So take us where you want to go. So if we're talking about a topic and you just have a burning question, just raise your hand and we'll try to take it then. The whole idea of this, we hope, is to be informative and interesting and
very informal.
Informal, right? So that was the thought. So John has been had an amazing career. He owes it all to the business school, is what he tells us. So thank you. And we thought we'd start off, maybe tell a little about your story, because one of the things I found interesting as dean, as I've gone out and talked to people, is how many people that have gone on to do amazing things, including John, came from our accounting program. And you may not know, there was a year in accounting where John and Gary Kelly and Phil Green, who's the CEO of Frost Bank, were all the same year in accounting, 1977, right? So it was a good year. If we had a few more years like that, that would be good. But let's start out, and then you end up accounting graduate, end up working for Richard Rainwater. So you want to tell a little of that story?
Sure. I'll give the Cliff Note version, but first, I want to give a shout out to this guy because he's incredible. Jay has energized this program like no other, and we're very, very fortunate to have you. Thank you.
I appreciate it.
Okay, Cliff Note version. I grew up in a small town, and when it came time to go to school, I wanted to go to UT, and I wanted to study electrical engineering. I needed to do some work to help pay for school, and Dow Chemical had a program where if you worked in the summers for them as a student engineer, they would basically they would underwrite most of your school. So it was a great program. So I started out in electrical engineering, and I actually loved the coursework, and that was I was pretty good at that, at science and math and things like that. And the third summer that I worked with Dow, I got to interface with business people because we were building a plant down in Sao Paulo, Brazil. And I was in this meeting. There were all these engineers on one side and business people on the other. And literally within 30 minutes, I realized I'm on the wrong side of the table. So I came back to school, changed majors, picked accounting, because back then it was the #1 accounting program in the country, and I thought, okay, I'll switch.
Still is.
So I crammed all crammed all my accounting in a very short period of time, which I have to tell you was so grueling. That was, in engineering, they wanted you to succeed because there was a desperate need for engineers. The accounting program, they wanted you to fail because there were too many kids wanting to get into the accounting program. So it was really tough, and I got to tell you, it was a lot harder than engineering. But anyway, got out in accounting and went into public accounting. Hated it, basically, is a quick answer. But I'm being extreme. It was a great place to learn business. And I think there's no better way, in my opinion, to learn business than to go through that approach. But it's like learning it through an IV drip. It's a lot of time, it's just detailed, and I knew that's not what I wanted to do the rest of my life. And so I had this incredible break. I was working for Pete Marwick at the time, now called KPMG, in Fort Worth. The Fort Worth office of Pete Marwick was a very important office because it had the Bass family as its client. So it was an outsized office for such a small city. And it was a wonderful experience. And through that, I somehow got on an engagement and interfaced with the chief investment officer, a guy named Richard Rainwater. And he, for whatever reason, liked me, and he ended up saying, I want John on everything I do. And so I would literally spend days in his office, just sitting in his office and doing whatever he needed done, and I was coordinating all the resources of the firm. And it was just an amazing experience. Then he left the Basses in 1986, and in June of 87, he said, come join me, and I did, and I didn't even tell my wife at the time. I just said yes. Had no idea what I was going to make. It didn't matter. That was the turning point that I was looking for in my career, so I was just very fortunate to have met him and that he believed in me, and I immediately started working on investments. The crazy thing that happened, I joined in June of 87, and some of the older people in the audience know that in October of 87, we had this massive market meltdown. So Richard called me into his office, and understand I had not invested a nickel at this time. I had no net worth. He called me into his office, and he said, here's $50 million, go put it to work in the market. So in hindsight,
After the crash?
After the crash.
Wow.
And the day of the crash. The day of the crash. So I would love to think that he thought I was this, boy genius, but that's not the case. He knew that the market was so oversold, even this young, dumb kid couldn't screw it up. So, I put that to work, and that was really my first foray. I was sweating bullets. I didn't sleep. But he knew I could rip apart a financial statement and analyze a business as well as anybody, and that I give that credit to the accounting background. So it was a wonderful experience, and it went from there.
And what made him special? Like, what did you see that? When you get around these people, sometimes you think, okay, there's something there that's really pretty unique and special about that person.
He was, well, first of all, it was a odd relationship with him, phenomenal relationship. In many ways, he was like a father, but he was also like a brother and close friend. But we also ultimately were very close partners. I fortunately created a net worth through working on transactions with him, and so we ultimately became very tight business partners. But what was interesting about Richard, he never really provided guidance. It might be in spurts. You just had to learn it through osmosis, but he was so charismatic, incredible salesman, but brilliant at seeing around corners. And that's, I don't think that's something you can learn. I think he just had that innate, and but his enthusiasm was contagious. So he created this, this office environment it was like a pickup basketball game every day. You had no idea who might walk through that office. It was Michael Milken, when he was at Drexel. He'd be coming through with a whole flurry of people. And there was this view in the outside world that we had this gigantic office with all these people. There were like 5 people. There were 5 of us. And so it was, anyway, it was an incredible experience. Just one quick story. I started buying in the early 90s, I started buying assets from the RTC. And Richard, at lunch, we would have lunch together almost every day. He said, I don't know why you're messing around with all these little assets. He said, why don't you just make an offer to buy the entire RTC? And I said, are you kidding? And I said, well, how are we going to pay for it? He said, I don't know. We'll figure that out. Just make them an offer. So I write, Bill Seidman was the head of the RTC at the time, so I write this letter, Dear Mr. Seidman, and then I go into why I think we should buy the RTC. Well, obviously, I think Seidman fell out of his chair laughing when he got the letter, but we ended up having a meeting, and I said, Richard, I've actually got a meeting with Bill Seidman in Washington to talk about buying the RTC, and he said, well, good luck. I thought he said, I kind of thought it was a crazy idea. I had no idea you'd get a meeting set up.
And how old are you at the time?
I was like early 30s.
Yeah.
So.
And so roll the clock forward. So one of the, part of how we got to know each other was through the real estate program that we'll come back around to. But, one of the ways that you're well known is what happened with Crescent and around the big run-up and then the financial crisis. And I've found it interesting in the last few months, people starting to, I guess they've been talking about how long this run will go and is this time like last time and what's different. And so if you wouldn't mind, reflect back a little bit, put yourself in your 2007 hat. The other thing I've been doing, this is more about me than you, but I've been watching Succession on HBO, and so I'm in my mindset of you have this company that you and your team have built, and it's '07, and there's a time to potentially sell.
Yeah.
What are you thinking at that time?
There was nothing to buy, and the way you grow in the REIT world, we were a publicly traded real estate investment trust, is you acquire assets, and there was just nothing to do. Everything was overpriced in my mind. And I was in a board meeting, or actually, I had a meeting with Morgan Stanley, actually at my lake house. I had a bunch of their team in because they were very enamored with our asset base. And we had a very eclectic portfolio, so it was a tough company to get your arms around. And we were criticized by that sometimes by the public markets because we tended to do a lot of different asset categories, and it worked well, and we provided great returns, but it was tough to analyze. Anyway, they liked a lot of our businesses, and so they intimated that they may have an interest in buying it. At the time, they were managing $60 billion in their various what was called MESREF, Morgan Stanley Real Estate Funds. So this was institutional capital. So I had the whole team, or a big part of the team, at my house, and we were having margaritas, and they said maybe we just ought to buy you. So I immediately set a board meeting up, and I had a heck of a time convincing the board to even engage in the discussion of selling the company. They said, look, you're doing a great job, company's on a high, stock's doing well, just keep doing what you're doing. But I was other than Richard, I was the largest shareholder in the room. And I said, look, the exposure here, if we have any kind of adjustment in the economy, is very significant to these real estate assets. And we have potentially a natural buyer for this very expansive portfolio. And long story short, I finally ended up convincing them. And the way I did that is I gave back to the company part of my recent compensation package. It was a new option package. And I did that saying, look, I really mean business. We need to sell. I cannot say at the time, this was February of 2007. So the wheels had not come off. And I'm not about to say I was smart enough to see what was about to happen. I wasn't. But nothing felt right. And we had this natural buyer, and so I took advantage of it. The most important point in that negotiation is, and I don't know that I've ever talked about this, but normally when Morgan Stanley real estate funds acquired a company or assets, they gave you, the commitment was from the fund. In our case, this was a $6.5 billion acquisition. They needed to go raise a new fund. And I said, now wait a minute, you're going to go raise a new fund. I'm nervous about the environment. I said, I can't take a contract to my board, much less my shareholders, from a real estate fund that's not yet formed. And they said, oh, we don't have any problem raising money. We just, it comes to us naturally. It's very easy. Don't worry about that. And I said, no, I am worried about that. And they said, well, what do you want us to do? I said, I've got to have a guarantee from Morgan Stanley Corporate, the investment bank. And they said, we've never done it, can't do it. Well, John Mack, who was running the company at the time, was a friend of mine, and ultimately I had to negotiate that with him. He probably hates me today, but but lo and behold, August 3rd, 2007 came around. They could not raise the fund, so guess who got to close it? Morgan Stanley Corporate.
Morgan Stanley, yeah.
So without that guarantee, that deal would have never happened. And the treasurer or the CFO of Morgan Stanley Corporate woke up the next day and was like, what the hell is this? A $6.5 billion real estate company fell in his lap. And it was a big company, but that was a huge asset that all of a sudden, or ultimately liability.
And levered up at the time.
They only put $1.1 billion of equity. I told them there's no way you can operate this company with $1.1 billion of equity. They borrowed $3.7 billion from Barclays Bank and then assumed debt for the balance. I said, it won't work. And they said, we know how to do this. We'll run it. And they wanted me to run it, and they wanted to fold up a lot of other assets underneath. And so I did that for about 30 days. And then I just called timeout. And because they had all these people in, this will sound bad. I don't mean it bad. But a lot of newly minted MBAs coming in trying to tell me how to run the business. And so I went to New York, and I said, look, we're all friends. You gave me this big contract. Let's just tear it up because I feel like I'm running the post office. I've got to go through all these approvals, and I can't do this. So we parted in a friendly way, and it wasn't 18 months later, I got the opportunity to buy it back.
Yeah, that's what I was going to ask about next. So tell that. So those of you that may not know the whole trade, so I think we teach buy low, sell high. You did it. You just sold high first.
Yeah.
So help kind of walk the audience through what happens 18 months later in 2009 and what the opportunity looks like then.
Well, this was the summer of 2009. I got a call. At the time I was working with KKR. They wanted to buy this other real estate business that I was creating, and they wanted to work with us on a broad scale. So I got this call from Barclays, and Barclays said, do you want to buy your company back? It looks like we may get the keys. And I said, sure, but you're going to not like the price. And they said, well, try us. And so I talked to KKR and Henry and his team, and they were all over it. Perfect setup for them. Back an ex-CEO to buy his company back, got a big discount. It's perfect. Anyway, we could never agree on a price. With Barclays or even with KKR, and I could agree on a price, but not with Barclays. So ultimately, I got a call from London, a guy with a very thick Scottish accent, my assistant told me, and I quickly Googled him and realized he was like the number 3 guy in Barclays. And he said, hey, I want to meet you. Can you be in New York tomorrow? And I said, sure. So fly to New York, and literally in 24 hours, we cut a deal. He said, his thing was, I'll never be able to sell it to you because we can't take the write-down. There's going to be a multi-billion-dollar write-down. But what I will do is partner with you. So we partnered, bought the company back, and I count my blessings every day. It was right place, right time.
Yeah. And speaking of time, so back to this question about where are we now, and is there anything today that feels like 07, or is this, we started for the first time this school year, I've heard among the MBA office, recession planning. Like what's the career management office going to do if things have changed, and do you feel any of that today, or and the second part of the question I guess would be, how much different would your answer be if we weren't in Austin, Texas, or in Texas?
Well, I'll answer that one last. Yeah. Well, first of all, let me answer that one first. It'll be easier. The single most important data point in the real estate business that I watch is population growth. Population growth of the U.S. has been on a decline, but it's kind of leveled off at 0.8%. So that means on a net basis, we add a new person every 16 seconds. What's interesting, you do the math on that, that's like 3.5 to 4 million people a year. That's like 4 of these cities, 4 Austins. Every year gets added into the U.S. So the question is, where is that happening? And in our real estate operation with Crescent, that's what we drill down on intensely. Where is this growth occurring? Because it's not uniform across the U.S. And I will tell you, the big part of it is right here in our backyard. So to answer the second part of your question, it will be less of an impact because we have a bigger wind to our back here in these economies that have favorable state governments, low taxes, all the, central time zone, great transportation systems, except here in Austin. It's son of a gun to get around. But this is the place to be. And, I would say you can make an argument for a lot of different cities. Denver is a big city that we're focused on. Boulder, Colorado. We're focused on some of the Florida markets, and Nashville. There's lots of cities. But so those cities will fare, those communities, those areas will fare better. So then the first part of your question. So we've been having steady growth now for 40 quarters, which is a record in the U.S. history. We've never had a recovery that has lasted this long, ever. The average recovery is like 3.2 years. And then you revert back, you have a recession, you come out of it. Recessions typically last 1.5 years. And when I look at the environment today, I would say that recovery's in because of 2 things. They either end because of excesses, and I don't see the big excess right now. I don't see it. I do worry about these incredibly low rates on a worldwide basis. You now have $17 trillion of sovereign debt that trades at a negative yield. I'm not smart enough to know what that's telling me, but I worry about it. It doesn't seem natural. It doesn't make sense. How that translates into recession, I can't connect the dots, but it's something I look at and try to understand. So they end because of excesses. I don't see the excesses in lending. I just don't see it. Not right now. Or they end in government policy, bad government policy. And I would say that the next recession will be because of that. And my biggest fear right now is the extreme polarization of the political climate. We're just dealing with such extremes. And I don't know if you heard what Leon Cooperman said yesterday at this interview. There's a big investment conference. And he said that if Elizabeth Warren or Bernie Sanders get elected, the stock market will not open. And he's a smart guy. I'm not saying that's right. It definitely will be a delayed opening. So I really worry about that extreme and where that could take us as a country. And I'm not trying to politicize my answer here, and I don't want to dive into politics. Because, look, I don't like a lot of the things that are going on. But from an economic policy standpoint, we're doing a lot of things right. Reducing regulation, reducing taxes. These things work, and the numbers bear it out. And I'm a data nerd. I study data intensely. And I just don't understand why we have to have these extremes. There's got to be something that makes more sense in the middle that would be very business friendly and continue this wonderful capitalistic system that we have in the United States. And for some reason, we have to deal in these crazy extremes that just don't make any sense. It would be a disaster if we went to this extreme socialism. It was Margaret Thatcher, her famous line, socialism works really well until you run out of other people's money. And that's, I don't think it could be stated any simpler than that.
Yeah.
I hope we're teaching our kids that in economics.
We are actually, this last week, just a
I will politicize that.
A plug for one of our events. We had an event this week on capitalism versus socialism. And we've talked to people and there's a concern, I think, in part that the next cycle is going to be a referendum on capitalism. And it doesn't always and there are obviously issues going on, but it also may not be fully understood as the driver of job creation, standard of living,
Yeah.
right? The human condition that people often, they don't understand and connect those dots.
Right.
So we're trying to help our students with that without going into.
Yeah, there's never been an example in history of the world that it's worked, ever.
Right.
Just doesn't work. So I don't know how we have to go, why do we revisit something that doesn't work? But anyway.
So back to where our opportunities. So I'm imagining your family office now or through Crescent, you're getting inundated with ideas and pitches. What are you seeing people pitch as places to invest today, and what are you excited about?
I'm most excited today about two things we're doing. One is Canyon Ranch. I was fortunate enough to buy the company. It was part of Crescent. So when I bought it back, that was part of what I bought back. And then I bought out Barclays, and I bought out the founders. So we own 100% now in the family office. It's got enormous growth prospects, and it's this, there's 2,000 employees. We're on 22 cruise ships. We've got 2 resorts, a third about to open, largest spa in the world at the Venetian in Vegas. And wellness is more relevant today than it ever has. So I am inundated with ideas and things, interesting things to grow that business. So I'm reinvesting a lot of our capital back into the company, and I'm big on that. The second thing is oil. I'm a oil bull right now, and it is as interesting today as real estate was in the early 90s, the oil business. So I've made a bunch of different investments through the family office in various oil companies and distressed debt, all kinds of things related to oil. And we're starting to consolidate those investments into this company that it's a tiny little public company that we bought 20% of called Contango. I recently invested more money, and so we now own 35% of the company roughly. I put the guy who was spearheading all of our energy efforts in as CEO, and we're going to use that as a platform, and there are all kinds of interesting things to go buy right now, so at crazy prices. So it is a very, very interesting time in that. The other thing that I know you were talking to one of my partners, Ted O'Neill, who's here, is entertainment, and we have a very interesting live entertainment business that I'm excited about, where we take all these great properties, whether it's Game of Thrones, which we have the rights to now, Dr. Seuss, Peanuts, Hasbro toys. We've got all these things, and we've got these, creative geniuses that turn these into live entertainment experiences that we open up and travel around the world. Great business, great cash flow, relatively small today, but it's going to be a big business, and so I'm excited about that. And then also falling into that category would be esports.
Yeah. Tell that a little bit about just a few sentences of what you're doing there.
Yeah, so I've got my younger son, Christopher, here, but his older brother was a big esports player in high school. Always worried about somehow he got his schoolwork done, but he loved football, he played tennis, but at night he was playing Counter-Strike and very serious about it. And when he ended up going to UT, he actually got a letter or an offer from a professional team that he had played some with that offered him really good money to join their team, but he was going to have to move to like Norway, and because it was a team that was based in the Anyway, I said, well, that's not happening. You're going to go to UT. So anyway, he goes to UT. But anyway, he's been the insight into this whole world of esports. And so about 2 years ago, we had a esports team come to us that Travis, my son, knew about, which is the oldest team in the U.S., run by a very good guy, and he needed to buy out his partners. So we looked at it, we kind of constructed a deal, and then finally I got cold feet because I said, look, the only way we can do this is if we team up with somebody who really knows what they're doing in the way of marketing, sports marketing. So called my good friend Jerry Jones, owner of the Cowboys, and I said, Jerry, do you know anything about esports? And he said, what is esports? And so we met at a concert out at the stadium, and I walked him through it. And so we ended up doing it. We brought them in as a partner. And it's amazing. So all these players that we have, they go to the same nutritionist that the Cowboys go to. If you look at our logos, they're kind of remarkably similar, but we had to pass the NFL standards. The NFL doesn't want you to use the logo again. They eat at the same training room that the Cowboys dine at.
Just a little less food, probably.
Yeah, they eat a little less. But anyway, it's amazing. And you've got this massive marketing machine. I've never seen anything like it. The back office of the Dallas Cowboys is incredible, the machinery they have to sell sponsorships. So we're joined at the hip with them, and it's fun. Have no idea where this is headed, but I will tell you, there are more eyeballs on esports now than certainly hockey, certainly baseball, and it's about to eclipse the NBA. And within 3 years, it is predicted it's going to eclipse the NFL.
Wow.
So it's amazing.
Yeah.
So lots of eyeballs, and companies, consumer product companies, clothing companies, et cetera, really taking note, and they want to back because they want to capture those eyeballs.
Yeah. It's interesting how at that trajectory, and I'm still having a conversation with colleagues about what are esports, right? So it's such a big thing. We've got about 10 minutes, and I want to make sure we have time for questions. So if you want to get your question in mind, I would be remiss in my duty if I didn't plug our real estate program. And you've been a great sport. Thank you for that. And we're going to celebrate later today that part of your gift to the real estate program, we had a matching component, and we're signing the last gift in that match today. So we're going to fulfill that. So
awesome.
Thank you for that. That's right. Yeah. But maybe just before we go to the questions, a couple sentences, if you would, on what fires you up about the real estate program at UT and what got you willing to make that kind of investment in us.
Well, you did a good job selling me. Jay is a good salesman. Of course, he brought all these students in, and they all had their pitch on why I should do it, and I couldn't do anything but say yes. But here's what's really interesting. If you look at the landscape of real estate programs throughout all the major universities in the U.S., it's kind of it's open for somebody to really take the lead and be the number one program, and that's what we're going to do. It's not that that's our target. We are going to do it. So if you look historically, Wharton always had Peter Linneman. Berkeley had a strong program with Ken Rosen. Ken's about to retire. They're trying to find his replacement, I think. Mm-hmm. Peter is retired doing other things. And those have kind of been the two big strong programs. What we're doing is way beyond anything either of them really did, because now we have this, our students can invest in publicly traded REITs and other real estate related securities. And we've got real money that they're investing, profits of which will go back into the system, which is wonderful. And then we have now the private equity, and we did our first investments last spring, right?
Right.
So students, and there's no program like that in the country. The other component, of course, we've got the labs here where the students are in all these programs are going to be housed or are being housed. But now we have identified, but we can't announce yet, a leader of this program. So that's the other thing that I gave money for was to the chair. And we have got, hopefully, knock on wood, yeah. We've got a great person identified, and I think that we'll be bringing on who will be the, the real spokesman for this program and be what I would call kind of a thought leader that much of the real estate industry would look at and respect. And he would then, energize a lot of research and hopefully publications that'll emanate from the school. So it's very cool.
That's great. Thank you. I couldn't have done any better. So let's open it up. What do you want to hear from John? What do you want to talk about? Please.
I'm just curious, your first 50 million, it sounded like there weren't a lot of restrictions on it. So did you immediately go, oh, it's all real estate, or did you try to diversify, or did you?
No, at the time, I didn't particularly know real estate any more than I did any other industry. That's the kind of thing Rich would do. He gave me zero direction, and I'm not kidding, zero. He said, you figure it out. You put it to work. And I said, well, do you want me to tell you as I put it to work? And he goes, no, just put it to work. You know what you're doing. And so at the time, the market was so oversold. What I did is I quickly and we didn't have a lot of tools back then like you have now. You didn't have the Bloombergs and all that stuff. We had Quotrons and these other fairly not all that helpful products. But what I did is I created screens, and I could buy companies where their market cap was less than their cash on their balance sheet. And so I went highly defensive, and I bought really good businesses that I thought were bulletproof. There was just where they were trading below cash. And they're surprising how many there were. So I did things like that. And then I also bought just, really big cap names that were just way oversold and selling at extremely low historic multiples.
How long did it take you to put 50 million to work?
A couple of weeks. Yeah, I didn't sleep much.
Fun?
Scary as heck. I was scared out of my mind.
What else?
But no, it was fun.
Please.
Love to hear your perspective on trends happening right now and what it means for the future, like co-working spaces and how that affects real estate and Airbnb and hotels and all of that.
Well, start with co-working. That leads to a discussion about WeWork, but it's clearly, I think there's a market for that, and it's actually been around for quite a while. There's been a company called Regis Business Systems, and it's been around for a long time. We've leased to them for many years. WeWork has tried to take it to a whole new level. I think there's a reason that WeWork, they changed their name from WeWork to the We Company, and I think if you look at the financial statements, you'll realize why they dropped the word work, because it won't work. So it is just a quick pitch on WeWork. It is the most mismatched balance sheet in duration I've ever seen in my business career. $47 billion in long-term lease liabilities, $47 billion, if you add them all up. And they have $4 billion of relatively short-term lease agreements with, people in skateboards and sandals who are, leasing this space. And there's some legitimate businesses in there. I'm not trying to make light of it, but it won't work. It can't work. And if you take a business with that kind of duration mismatch into a recession, they will get crushed, and it'll happen fast. So
It's like S&Ls.
yeah.
I mean, it's just a different duration mismatch.
So I can be proven wrong. I don't get it. But is there a place for that in the real estate industry? Absolutely, and that's a trend that we're going to. But there's really nothing unique about what they do. They mentioned the word tech, I think, 120 times in their prospectus. And it's not a tech company. It is a real estate company. And you think about it. They signed this long-term lease with somebody like me, and I'm going to charge them like I do anybody else. So then they've got to mark that up to make a profit. And they're doing that on a short-term basis with people who have no credit, for the most part. It's just a dumb idea that somehow raised a mountain of money.
Go ahead and say what you think.
Well, I'm trying to, you told me to spice it up. Jay said make it fun. But to one other point, What's really interesting is go look at the financials of SoftBank, who's funding this stuff, and you understand why they stopped the public offering, because they were going to raise it at $47 billion valuation, and then said, oh no, we didn't really mean that, it's 20, and then they said, no, it's going to be 10. Well, SoftBank said, nah, can't do that. SoftBank is one of the most leveraged companies on the planet. They have $160 billion of debt, $160 billion of debt. And they have, that debt is like 6 times EBITDA. That's a recipe for a disaster. I just don't know when it's going to happen. But anyway, house of cards. I think co-working space makes a lot of sense, and we actually do it in kind of our own design in some of our buildings. But it's a very good way to nurture new tenancy and bigger companies, because that's, everybody gets started at, new companies get started very small. In terms of the hospitality side, Airbnb, clearly a trend that has caught hold, and it's real, and now you even have big companies like Marriott doing their own version of that. I would call it more of the, it's the lodging business. It's not the hospitality business, because there's no other engagement with that customer. You're just simply providing a place to sleep. And I think there's going to be a place for that.
Maybe one more? Yeah, Cameron.
Yeah. Is there anything you can tell us about Contango? For instance, are you trying to go toward the Permian or trying to go way away from it?
Not focused all that much on the Permian per se. We do have some really great Permian acreage that we're going to take advantage of that's in the Delaware, and that's going to be a focus. But we're not a big enough company to be a big driller in the, we're going to try to make our money not with the drill bit, but by buying cash flow. And right now we're in this moment of time, you can buy cash flow so inexpensively. So that's our focus. And that could take us to other fields, outside the Permian.
So the public market's been your friend on that? The public market pricing of energy companies, is that present some opportunities for you?
Yes, definitely. Definitely. And Contango has suffered because we had our bank credit agreement coming due and we had to replace it. Well, we just announced we did replace it, led by JP Morgan. So we have a brand new, great facility, 5 years, and I put up more money and others did as well. So, small, but it's a really interesting platform to get started with.
Great. Well, thank you all. Christina's standing up, so that my time is up. Thanks, John. Thanks for doing that.
Thank you so much, John and Jay.
You bet. Thank you.